Yes, yes, very clearly.
Okay, great. Welcome, sir.
My pleasure, my pleasure.
Great, sir. So, guys, let me take a moment to introduce our guest for today. Samit Vartak, sir, is a founding partner and CIO at Sageone Investment Managers LLP. He has been in the equity market since 1999 and overall experience of 24 years. He has worked closely with various company management in the US and India, advising them on the business strategy, profit optimization, growth, and valuation. And this has formed the backbone of the process which Sir follows and understand the nitty-gritties of businesses and finding value in them. He has been early in identifying and investing in multiple businesses across industries before they catch market attention. And by education, Sir is a CFA charter holder and MBA from All-in School of Business of the Washington University in St. Louis. And he also holds a bachelor's in engineering with honors from Sardar Patel College of Engineering from Mumbai University. And Sir actively shares his knowledge and learning through widely followed investor newsletters, lectures at CFA Society, industry forums, business schools, and media interviews. And Sir returned from US in the year 2006 after spending a decade in the US, working initially in the corporate strategy with the uh, GAP, INC, and PwC Consulting. So, a very warm welcome, sir. Just in case I missed anything on your introduction, I would request you to surface on that and welcome again.
No, no, absolutely covered everything, everything more than everything.
Thanks.
Thank you so much. It's absolutely my pleasure to be here.
Great, sir. So, to begin with, sir, when we start our investing journey, initially we all are clueless where to start, what to read, how to behave, etc. What would be your advice on this in line with your journey and evolution in last 24 years in the market? Would love to hear from you the framework which you follows. Yeah.
Sure, sure. See, I mean, once when you start, there are so many different ways of investing. People, from Warren Buffett to Peter Lynch and Monish Pabrai, and even in India, the way Sunil Singhani invests versus how Prashant Jain invests or how Rakesh Jhunjhunwala invests. There are very different ways of investing, right? Question is, which is the style that fits you? What you are good at, what you like, and what fits your temperament, behaviorally, which style really suits you. So that's something that you need to figure out yourself, right? You can't just copy paste any idea or any investment style and try to apply it to you, because that is successful for that personality at that point in time, and things would change. Your personality is different, markets in India are different. So you can't just copy paste from, say, US for a specific investor. So you need to do some trial and error. When you start, that's the best time to try different styles out. After you have spent like 10 years, 15 years in the industry, and you still are not clear what really works for you and what is the style to follow, then it's probably too late. Of course, I mean, there is never too late. This is a long journey, but the earlier you make the mistakes, the earlier, the less amount of money you will pay in tuitions. So that's what I would say, that if you are at the start of the journey, read about different styles of investing, what has worked for different investors. Make sure that that style really fits the Indian environment, and it fits your temperament, it fits what you really like to do, and then accordingly go. So, for example, there are, I mean, a lot of people also make money in momentum or make money in trading, right? So, nothing wrong in that. That's the way they have made money, they are very successful at it, and it fits what they like. If I try to do the same thing, I would probably not even like the process. I should enjoy the process or enjoy the journey also, not just focus on the end result, because money is not the end goal. You should also enjoy the journey, develop your own thesis, improve upon it, keep learning, and become more and more good at it. So unless you enjoy the journey, you'll not really have that motivation, to keep on improving. So I don't want to give a plain simple, way of investing. I think everyone knows different styles of investing. It's up to the individual to make sure that he makes the right choice.
Right, sir. So basically, what we struggle the most is, and we often see that we look for borrowed conviction, and on the same lines, like whenever something comes to our mind and we like the idea, so we are basically looking for confirmation bias on that front. So how we can like get rid of that and improve on that front?
Yeah, I mean, see, there are different. So, for example, today's time, right? Today's time, there is so little time to do deep dive, because by the time you do deep dive, if you spend a month doing a deep dive, a lot of stocks would just run away, and you may not be able to buy. So that's an generally an easiest way of making mistakes, and generally you would go along with the borrowed conviction. You would maybe talk to your friends, or maybe set of investors, or if you like some investors, you see that investor investing, and you would think that, okay, if he has done the work, let's just go along. That's, I think that's a very, very wrong process of developing your investment sort of career, or investment abilities. Because only if you go through the process of building the conviction yourself would you keep on increasing your knowledge. If you just keep on working on borrowed conviction, 5-10 years down the line, you would really not be much different than what you are now. The goal is that in 5 years, in 10 years, the knowledge itself has to compound. You need to be a learning machine. And that can only happen if you actually work on the companies, make mistakes, figure out what exactly went wrong, avoid those mistakes, improve upon them, and make sure you develop your own process. So borrowed conviction may work in the short term, but when the real tough market comes, you will pay tuition for it. And sometimes you make so much money, and then over 2, 3, 4 years, in a matter of few months, you would lose all of that. It's easily possible, unless, especially if you are working on borrowed conviction, because the as people say, right, the markets go up on staircase, but I would say it comes down like a bungee jump. And so avoid that.
Right, sir. So sorry to say, but some people are complaining about the voice issue. Am I properly audible to you?
You are extremely, yeah, clear to me.
And same is, I mean, I can hear you properly as well. Not sure. So
Okay.
shall we like try dropping and starting again, or the guys can listen to the recording later if not everybody is experiencing it? Hi, sir.
So I can again hear clearly. So hopefully my voice is also clear.
Yes, sir, it is also clear on my end. So
Okay.
the people can, I mean, we take 10 seconds for people to tell, like, sir, can you speak while so that they know because your voice is more important. I can manage.
Okay. Okay. No. Hopefully, I think even the new joiners would are able to hear me. And I don't even know how to check, but I guess there must be a message board. This is my first spaces, so um,
It's fine, sir. I just
yeah.
checked the
Okay.
comments and they are fine, good to go. Thank you, sir.
Sure.
Sorry for the inconvenience.
No
So, sir,
problem.
we were discussing like these days there is a problem of plenty. Uh, I mean, we get too many ideas, and it is very difficult to make a segregation. How to like behaviorally control that aspect and limit our universe where we can like do our due diligence in a better manner. So how you do it, sir, so as to like get rid of this all noise happening around?
Right. So see, I think once you know what exactly is that you looking for, when once you have clarity on your philosophy, the job becomes relatively easy. So for example, what say I look for is companies who can double its earnings in the next 3 to 4 years, right? So that's like my key requirement. Even if something is extremely cheap, but if there is no growth, I will not go for it, right? So that way I know which are the companies which I do not want to really touch. They are of no interest to me. So if I can narrow down my universe, right, and then from them try to find out which are the best companies, it makes job much easier. So if you, I mean, there are so thousands of companies available in India, right? So even for a fund manager, there are at least 1,000 companies that in which I can invest. And if I have to work on all the 1,000 companies, impossible. I need to narrow down my universe from 1,000 companies to maybe like 150 companies. 10-15% is what you should be able to narrow down. And once you have 150 companies, from there maybe 10% of those is something that would become part of your portfolio. And you need to use maybe overall screeners to make sure that the companies that become part of your universe, that 15% or so or 20%, they comply with what you're looking for, right? And that makes your job. Otherwise, I mean, that's the problem, is that you will get bombarded. And especially if you are part of many WhatsApp groups, you'll get so many research reports. Within the group there will be investors who would say that this stock is going to double and this is going to triple. There are very confident investors in different WhatsApp groups, and then it's easy to fall for that FOMO kind of a feeling, and then without doing much work you would just go for it, and that company may be completely out of your investment style, and still you'll go for it because someone has told you. So you should make sure that you have full clarity at your end, and that would help you eliminate a lot of noise, because it's all about focus. You need to work towards developing focus, something where you are good at it, something where you are better than the average. Only then you'll be able to create or generate alpha, and that's what you should be focusing on. Right now, in the initial years, I wouldn't say you should focus on just making money. Forget about just making money. Money will follow. Develop your knowledge. That is what will make you real wealth later on. Even if you don't make money in the first cycle, no, don't make any money in the second cycle, but the third cycle is where you should target that I will make a lot of money, because by that time you would have done a lot of mistakes, you would have honed your skills, and your focus will be sharp in what to build, what to look for. And so think longer term, and don't lose out on learning abilities, developing your skills in the short term.
Right, sir. So you talked about the screener thing. So basically, so as to like limit our universe, what all criteria do you follow in like screening those opportunities? Is
Yeah. So see, for me, if I'm looking for companies who will double its earnings in the next 3 to 4 years, 4 years mean about 18% kind of a earnings growth, and 3 years is obviously 26%. Right? So how does company generally grow? Most companies grow by putting up assets. They have to spend money on capex, and where does capex money come from? Most of the capex money should come from internal accruals. And what is internal accrual? Internal accrual is basically the return on your equity, right? ROE is something that you make. Part of it you pay out as dividend, and the remaining part you reinvest into the business, and that helps create growth. So if I'm looking for 18% minimum growth, I should look for ROE which is at least 18%, right? So if they invest the entire 18%, at least it will help them create that 18% kind of a growth. So that becomes my first criteria, that ROE has to be at least 18%, and at the same time maybe ROCE also about the same kind of a level. I want to also make sure that, because ROE and ROC are more metric of your PNL, I want to make sure that I'm not missing out on the cash flow, and the balance sheet is also good. So then I make sure that my operating cash flow is at least as much as the net profit. So that ratio, so that helps me at least in the first screen. Later on you can do a lot of in-depth work, but in the first screen you want to make sure that the operating cash flow is at least as much as the net profit over a longer term. That's the second. Third thing is volatility in the margins, operating margins, because volatility in the operating margin just is an indication that that business, how cyclical is that business. Because if the margins are going to be like 3% and sometimes 30%, then you don't know what is the sustainable real margins, what is the sustainable profit, right? So like my process would go into businesses where there is reasonably, every business is generally cyclical, but how much cyclical. You want your businesses to be generating margins which are more in the control of the management, more in the control of the promoters. So one of the indicator is how volatile is the, say, EBITDA margin. So that's my, say, third indicator. And then also I look at historical growth, because see, company can't just start growing suddenly. It has to have inherent structural growth, and if that is the case, then in history there is, if not the kind of growth that you're looking for, there is that growth. And fourth, we also look for, maybe not part of the screener, but part of the alert, that they need to have announced some kind of a capex, or maybe they'll put up application in for environmental clearance. So gives you an indication that there is a growth opportunity. And that's those are the few parameters that generally I focus on, and that narrows down the universe significantly.
So this is like, for example, out of 1,000 companies, this is 150, and then further you go for 10% of out of these 150 companies, for example. So what further? What is the next steps once you identify these companies, and then how it goes, sir?
Right. So see, until now it's all backward looking, right? Because it's all based on the available data. Now from 150 to 15 is forward looking. That's when you need to sort of make forecast about the future earnings growth. So that's where you need to delve a little bit more deeper. So some research you can just go through. There may be some analyst reports. There could be some uh, management talk or some guidance that they have given. So we spend a lot of time on, say, evaluating what is going to be the return on their incremental capex that they're doing. Because sometimes the historical ROE ROC may be great, but the future growth may be coming in a poor quality sort of investment. So you shouldn't, you should make sure that that return on investment on incremental capex is at least meeting your hurdle of 18%. And so that's what we try to ascertain. Then we go and meet the competitors, because see, 18%, 26% kind of a growth is not easily possible at an industry level. So such growth only happens if the company is able to take away market share from the competition. So in isolation you can't really do work. You need to also study what the other players are doing, and who has the best strategy, because that's the only way you can confirm that this company should be able to take market share going forward. So that's what we spend a lot of time on, evaluating different companies within that sector, who is putting up capacity, who has, like, whatever the moats, and again, we can go into moats, but who has those competitive advantages, what are those competitive advantages which will help them gain market share. You spend a lot of time on evaluating those factors, and then see where the highest conviction and highest growth is available. And once you like the business, and then you look for valuation. Generally we don't really jump right directly into the valuation, but first make sure that the business is something that you like, the competitive advantages are sustainable, they will gain market share over the long run, where they will, if the industry is growing at say 12-13%, they will be able to provide say 18% plus. And then once you're comfortable with the growth, then you look for valuation. And so 150 to 15 has a lot of these factors, and valuation sometimes is a big factor because a lot of companies may be very expensive and do not meet the attractiveness criteria that you have. They may meet the growth criteria, but that's not, it's the most important factor, but it's not the only factor which will help that company to get into the portfolio. So those are the factors that you do, but a lot of work is all in understanding the business. And when you study the competitors, you understand the business much more. You understand how and what differently everyone is doing, and then you track that industry well, and keep on developing knowledge about that industry.
Right, sir. So you were talking about the cash flow thing. So what hygiene check or sense check we can do so as to certain the cash flows are real and going forward also the company will generate cash.
Right. See, now there are various ways you can do it. I mean, two or three ways that have helped us is, but sometimes it's not easily possible on sort of free service. You need to pay for those databases. So, for example, if there is an export-oriented company, and especially in the small cap space, where maybe there is always a question mark on the quality, right? So, if the company is claiming that they export to so and so customers and export to so and so countries, whenever someone exports, there has to be a lot of filings, on the government websites, right? So all the export import data is has to be filed, right? And that data is available across the world. So any company shipping from China to US or India to US or India to China, that data is generally available on a weekly basis. So first thing, so it's not just about the cash flow, but it's also about whether the business is real. That is the first thing that you need to confirm. And the business, can be claimed by the company, but sometimes many companies can also, fudge that kind of a data. So one needs to make sure that it matches with what the company says. If the company is saying they have a large customer in Germany, then that trade data is generally available, that there is an export data. You can have that code number for that product, and that gets exported. Secondly is the GST filing. A lot of GST filing is actually available even on if you just do Google search, when was the last GST, what kind of turnover. But if you can get access to the GST filings, you can see whether those filings reconcile with sort of the top line that the company claims. Third way is connecting with, or at least if you have good connects at the CA community level, auditor level, generally they are aware, depending on who the CA is of the company or who is the auditor of the company, on what quality can be, because there are certain notorious CAs and auditors where if that name appears, it's a big red flag of the company. And then there are various other checks. You can always, if you have the right connects, you can connect with someone in the customers. So one of the companies, we connected with the purchasing manager, and the feedback was extremely negative about their products. So company can claim that that's our largest customer, we have been dealing with them for the last 10 years, but when you actually hear from the other side, you hear very different kind of feedback, right? So there are a lot of ways. First, you need to make sure that whatever is on the paper is real, because you will be surprised the disconnect in so many companies, especially if you're dealing in the small and mid cap space. So that's the first thing. And then secondly, from that PNL to whether there is a cash flow, you can do a lot of reconciliation between the balance sheet, cash flow, and the PNL, to make sure that once you at least get that confidence that the business is real, the numbers they're talking about, top line, is real, and then you check, for the asset turns that they're talking about. Sometimes, global asset turns are like 1 times, and these guys are claiming that they're 4 times asset turns. There is a red flag. So anything which is beyond the norm of the industry, but you need to know those norms. You need to do analysis of those norms and make sure they match. The capex. If they say that okay, there is a 1 million ton capacity they're putting up, and the global trend is that you need $1 billion for that, but this company says okay, we just need half a billion. There is always a question mark. You need to make sure why is it half a billion. So that questioning is important. Questioning, digging through, and making sure that it's not a fraud. It's very very important. And for each industry, for each company, you could be, it can be completely different kind of an investigation, but something that you need to put your thoughts through.
Right, sir. One question before I allow speakers for their question. So, sir, how you react when you listen to some disconfirming evidence about a company you are very positive about?
Yes. So see, now that's a very difficult thing to train your mind doing, because generally if you hear anything which is opposing your views, you want to block it. You generally have so much confidence in your own view that you disregard saying that maybe you haven't done work, and generally it's just a natural tendency to sort of be blind to it. So instead of getting sort of defensive about it, it's an opportunity to learn more. I think once you are invested, it's more important to talk to negative views about that company, right? Because there are two things. One, if there are negatives, which are in the market, generally stocks sometimes, also correct, right? And then if after doing a thorough investigation on both the views, if you finally conclude that you are right, then either you can, add more, or you can, be very convinced and have the ability to ride through the volatility in case the stock goes down, or so it's important that you give much more importance to the negative views versus positive views, because it's very natural that you will form a group which is mostly aligned with your thought process, because that gives you more happiness. But you should focus on what will give you the end pain. Investing is not just about getting in, but getting out sometimes is even more important. I've gone through mistakes where the stock has become 2 or 3x, and because I couldn't or I didn't exit at the right time, I've given up that entire returns. And in a 4 or 5 year period, the returns have been zero, from 3x to zero returns, and huge opportunity cost. And that mistake happens because sometimes you are not open to hearing, negative views. So, but it needs a lot of training of your mind to hear negatives, whether it's for your company or your own negatives.
Right, sir. So, Sam, but then you can quickly unmute and ask your question, and please ensure no stock specific question. Yeah, go ahead, please.
Oh, okay. Thank you, Fritz. I had pleasure meeting Samit sir and the team while launching their large and mid cap portfolio. They are just phenomenally well. In last memo, Shitish talked about you need to create a sound process for creating wealth in a market. So I have two questions. Lot of time due to valuation or market condition, lot of investment ideas not fit in your investment process. At that time, how do you take a cash call? And second question, when you get a new stock idea, how do you go deeper into that particular company? And can you please explain the process?
Right. So, no, you are right. I think, there are a lot of businesses that you would like at any point in time. Question is also about the attractiveness of the stock, right? And there, again, you need to have some framework about valuation. Now, valuation framework is a very long topic, would not be possible to cover. I mean, I have given talks on valuation where I've tried to explain the framework that I use for valuation is very different across different industries, across different kinds of businesses. But generally the P multiple is high for businesses where sort of the risk of obsolescence or risk of that business not surviving, is very little. So, for example, an auto company, like a say even a Bajaj, or doesn't get, even though it's a consumer play, it's a highly profitable company, huge cash, doesn't get as much valuation as what say an HUL gets or a Nestle get, because there is a possibility that a regular combustion engine, two-wheeler may not survive, after 10 years or 15 years. So there is a limited. So sometimes there is no terminal value that you can give beyond certain number of years. Whereas in an HUL or Nestle, you're almost sure that this business will probably be there even 50 years down the line. So there is a, if you look at the valuation, sometimes 60-70% of the valuation comes only from the terminal value, and that's where the P multiple actually is derived. So one needs to look at that parameter as a key. The duration of growth is very very important, and then the opportunity for growth also. So that is where it's not necessary that a 20 times P multiple is cheap or whether it is expensive. For some businesses 20 times itself can be super expensive, but for some businesses even 50 times multiple can be super cheap. So that is something that you can only sort of derive based on your understanding of the business, because unless you understand the business in depth, unless you understand the competition in depth, you can't really predict the sustainability of growth, the duration of growth, a lot of those factors which actually drive the valuation. So, one has to, in every market, you will have to focus on that. If you don't find the opportunities attractive, better to sit on cash. There is no point in just investing for the sake of investing. Just because investors have given me money doesn't mean that I, need to be fully invested all the time. Sometimes you don't find an opportunity, you just sit on cash until you find the right opportunity. Right, so that's one thing. Whenever there's a new idea that comes in, the same process repeats. Right, so it's all about first of all, predicting the growth. For predicting the growth, you need to see if that, what is the growth rate of the industry, and which are the companies who will grow faster, meaning that they will gain market share, and why would they gain market share. You need to figure out those drivers, whether they are sustainable, and there is no alternative but to study the entire industry, study the competition, and then pick, or make your choice of which is the best company to bet on. And of course then comes the valuation, whether then the valuation fits into your comfort zone. Not necessary that in every market you will find cheap and attractive valuation. Like in this market you will not find cheap and attractive valuation, but even if it's fair valuation and that the company is going to grow at 18-26% in that range, and the valuation is say 20% above what you think, oh, it's okay. I mean, you give yourself little more room in valuation. It's okay to go little bit wrong in valuation, but you should not go wrong in the business side. If you get the business right, maybe you lose 1 year's opportunity if the valuation is high, but in a 5-year period, at least you'll make returns in those 4 years.
Right. So, and sir, like before coming to Sajal sir, one quick question, like on the portfolio construction thing, like how many stocks you prefer in your portfolio, and when it comes to position sizing, like how it goes, you build a position gradually, or how it goes for you?
See, I have a very simple way of thinking about stocks. I mean, theoretically, as you increase the number of stocks, you can diversify away the systemic risk, right? So up to 16 stocks, you can diversify almost 96% of the risk, and beyond that, adding more stocks actually doesn't really make too much of a difference. At 16, you are well diversified, but you need to be pretty good at diversification. You can't just have one kind of companies or one sector companies. That's not real diversification. You need to have a well diversified portfolio. So then 16-20 stocks is more than enough. There is no need for adding stocks at that level. So if I say that my average holding is going to be 16-17 stocks, right, meaning that maybe 6 to 7% is the average allocation. per stock. So what I do is that my lowest allocation is maybe 3%, below that 7%, and 3% above. So the range is going to, if average is 7%, then my range is 4 to 10%. So when I start investing, typically I would start with a 4% allocation. I don't remember a company where I've started with a 10% kind of an allocation, because you need, as you travel together your journey with that stock, you understand the business much more, 2 months down the line, 6 months down the line, 2 years down the line, 5 years down the line. And accordingly, whenever you will get opportunities within that horizon where the valuations also will become very attractive. So then you keep on adding, and some stocks will go to 10%, some stocks may never go to 10%, right? But that's how I think, because the more number of stocks you add, diversification of course is great, but do you have the ability to track those businesses that much in depth? I can track maybe 16, 20 businesses well in depth, but tracking 50, 70 may not be possible. Then your quality of work drops. And then also, generally, if you're good at stock picking, why not bet on the best 20 stocks rather than, betting on the second best next 30 stocks? So, and so that's how, I think, and that's how I construct the portfolio. 4 to 10% allocation. I never have like 1-2% positions in the portfolio, but I also don't go at cost, about 10%. There are exceptional situations where I'm so convinced that I've gone up to 15%. But then if I buy, say, 10%, and if the stock runs up, I'm not going to trim it. I will hold on to the winning position until at least that allocation becomes 15% as a part of the portfolio. So that's my way of construction.
Right, sir. So, Sajal sir, over to you.
Yeah, thank you for the opportunity, Prince. Hi, Samit. I hope you are well. It's a
Hi, Sageone.
yeah, hi. It's a pleasure to interact with you. Uh,
Same here.
right, thank you. Just a few questions I have. Um, One is on management. So, what kind of managements or promoters you don't like, or you don't like to partner with, regardless of how good the valuations are?
Right. See, for me, the most important thing, of course, integrity and whether the numbers are right, they're not fudged. Those are extremely basic things, which have to be covered. You can't get into company where, it's sort of a fraud annual report, and the numbers are completely, cannot be relied upon. But my focus, everyone has their own investment style, but my focus is always on the execution of the management. And sometimes it's not possible that you would know the execution capabilities right up front. Sometimes you would know if the company has long history, and you end up talking to investors who probably have experienced the management. So, for example, APL Apollo, when say I invested in 2016, there was no reason for me to believe that the execution is going to be perfect. It's just that when you talk to the management, you get a sense that they're very shrewd financially. They know the investments, in terms of the efficiency, what kind of returns they will make. The numbers are at the top of their hand. So that's something which is very important to us. You need that sort of banya buddhi kind of a promoter. Secondly, the promote generally, because I believe in visiting plants, meeting even second level of management. I want to get that confidence that the promoter is able to delegate, because you're looking for a long term journey, and scalability only happens if the promoter is able to delegate, not micromanage, and not keep things to himself. Because that trait, you generally get a sense of the culture. There are people who are just yes men around, and if you find that, generally that company struggles to scale up. And in my experience, wherever the management has sort of let go of that control, have hired the right talent, and given them the right incentive structure, and given them authority to scale up, those companies have done pretty well. Of course, the promoter is there to guide, but the second level of management is also pretty good. So, for example, Bajaj Finance, Rajiv Jain, he completely turned around the story, and I've seen even APL Apollo also building the second level of management. They're very strong, at regional levels. That that they understand the business pretty well. But those are a couple of things that execution and scalability is something that is very important for me. There are many more things, of course, but those are the two critical things that I look for.
So delegation, I think, is a great point you raised, Samit, and many people kind of ignore that. So that's a definite value add. Uh, in terms of if the management is honest and capable, and that is of course it's a first filter
Right.
through the funnel.
Right.
Um, is it possible to validate the culture of the organization? So when you make a plant visit, is there anything that you actively look for in terms of some sort of a subtle sign in terms of perhaps the culture is not up to the mark, or anything, because culture also is a function of management, right? Management quality. Is there anything that we could look to sort of validate if the culture is up to the mark or not?
Right. I mean, one of the red flags that I've seen is that whenever you say want to visit the plant or meet a certain team member or meet the management, the promoter is always there. Like, so whenever generally he should be busy enough that he doesn't need to be part of a plant visit, and
Hmm.
that generally is a red flag for me, because he should be confident enough that his team will take care of it. So as soon as he allows you to meet multiple layers of his management, it gives me a lot of confidence. I've seen many companies where that doesn't happen, and especially in that mid cap small cap category, it's even worse. And then he spends so much time with you, and when you see that, that means he must be doing the same thing with even the other investors, that. So you get a first sign that probably delegation is not happening in that company. It again is a micromanagement kind of a culture that they are building. And when you talk to the independently to the second third level of management team, you do get some sense. And especially if you've done this many times, and if you've experienced many such teams, you do get a sense which uh, sort of which teams are empowered or which teams are just instructed and they are just the followers. So some things are softer aspects, but these the promoter getting involved in every meeting, and he's being part of every, if he's spending so much time with one investor, that itself is a red flag.
This was gold. This was really, really gold. And just one more question, and then I'll just
Please.
fall back in the queue. So assuming that the management is best in class, I mean, the best you could ever imagine, then it comes to the business. Are there certain types of business? So I know you don't like, so shallow cyclicality is fine. So maybe certain kind of chemicals as an example, because chemicals also is a cyclical business, but perhaps the cyclicality in a normal scenario, not the current scenario where we have just gone off the cliff, because 2021 was also a sort of a positive black swan for the industry, because those valuations, I've seen some of the IPOs come at that
Correct.
point in time, those were insane as well. So correcting 50% from those insane levels is absolutely fine, but generally speaking, because it's a proxy to consumption, it's shallow cyclicality. So compared to something like metals or paper as an example. But point is are there certain kind of businesses that even if the management is best in class, you perhaps will not go and allocate capital to those businesses?
Yes. So, I mean, this again, I've learned through a lot of mistakes. Is it is natural for an investor to look at the demand side only. That you only look at the opportunity size. But the mistakes that I've made have been more from the supply side. I have completely sort of ignored or kept it secondary how much the supply can come into that business. Because uh, I mean, there are so many examples, even in the chemical space, that during COVID, suddenly the profits shot up because there was short supply, a lot of chemicals, and the customers stocked up inventory, and then they were buying at any price, so the margins shot up. Almost every company minted money during that time, and there was a huge, because of profits and the demand, they extrapolated sort of, and then because they had the cash, everyone went for capex. And there was so much in some part of the chemical space, there is so much capacity that got built up. At the same time, China came back, and so you know the barriers to entry is more from sort of supply side, how much supply can come. I like to focus on businesses where the growth advantage will be to those one or two players. 5 years down the line, I don't want companies in China or some other jurisdiction also building up capacity, or within India, someone else also getting into that business, because then demand can be great, but if there are 10 players who can supply that demand, generally the profitability and the growth at the company level doesn't come through. So I tend to focus a lot on how will the supply evolve over the next 5 years or 6 years, and not just focus only on the demand, how it's going to evolve over the next 5 6 years.
This was really awesome. This was really awesome. Brilliant. Thank you. Thank you, Samit. I'll read you in the queue. Thank you.
Thank you so much.
Thank you, sir. So, Samit sir, recently in one of your interaction with the NDTV Profit, you had shared that apparently no growth appears in the economy, right? But there are certain pockets where valuation are comparatively rich. So, do you see, like, when it comes to incremental money, what would be your advice, like which pockets or maybe how one should go about putting the incremental money in the market at this point in time?
Right. Yeah, I mean, see, my point was that there is, if you look at the biggest crashes, whether it's the .com or the global financial crisis, or even in India when, we had the crash in, say, 2018-19 in the small mid-cap space, there were excesses. Excesses are seen in the economy and in the business, right? Excesses are seen in the financial system or the banking system. You see excesses in the promoter actions, where the promoter is, has so much confidence, he goes aggressively and puts up capex, builds up leverage in the balance sheet, and then is okay with loosening the credit terms, right? And so today, if you see, the credit terms are very strict. The working capital cycle is probably at the best level that we have seen. So that's definitely not a sign of excess. The leverage in the system is towards the lowest end. Again, not a sign of the excesses. The banking system struggling to find opportunities to fund. So again, not a sign of excesses. So that's what I meant, that if you look at, if you didn't have the stock market, then you would not feel that there is excess in the economy, which generally you feel at the top or the peak of a long bull run. Right? There is definitely excesses on the valuation side, and certain pockets are much more excess, and certain pockets are fairly. There is no cheap valuation that is that easy to find, especially in really good quality long term businesses. Some maybe tactical opportunity you'll find. So, see, in terms of finding pockets, is the same process that you need to follow. Again, looking at first focus on the business, secondly on the valuation, and again, valuation generally has a huge range. There is no exact valuation. There is cheap valuation, there is a big range of fair valuation, and there is excessive valuation. So if you find something in that fair valuation band, you can buy those pockets. Many companies are in that excessive valuation band, which you ignore, and you are lucky if you find something which is in the cheap valuation. But the process remains the same. the process of valuation remains the same. I try to avoid doing the relative valuation, because in a market when everything has gone up and you find relatively something cheap, when the fall comes, the entire whole basket comes down, and then relative valuation becomes a sort of a valuation trap. But yeah, this is the process that I generally follow.
All right. Sir, in terms of the capex recoveries, where you see the highest growth, and what's your view around the private capex? Has it like kick-started, or there is subtle element of the election overhang in the private capex? How you see that, please?
At least, my anecdotal evidence shows that the private capex, has definitely started. Even this, Spark Aventus report showed that the approvals at the banking system have been the highest ever, last. So they are like 70% above what we saw last year. In terms of number of projects also, almost 35% higher. So 3.75 lakh crores, I think, approvals have been. So that's sort of a precursor to the upcoming, capex from the private players. So at least there are signs. Many companies are towards sort of that 80-85% kind of an utilization level, and they have no option but to expand. Many companies have no debt, so there is no short of capital to invest. And anyways, it's so expensive to give out dividend, because the promoter themselves get the biggest sort of dividend, and they get taxed at the highest level. So rather than that, even if it's maybe at the lower end of their hurdle rate of return on investment, it makes sense for them to go for capex. So definitely I'm seeing even at a macro statistical level, there is a capex which I think at least is at the initial stage of happening. And maybe these state elections have given them enough confidence that they can go ahead with the capex rather than waiting for the the Lok Sabha elections.
Right, sir. So although you mentioned that valuation are not cheap and they are fairly valued, so any two, three pockets, sir, I mean, if you would like to talk about which appears maybe reasonable, or one can have a look with a horizon of say 3 to 5 years from here.
Yeah, I feel, chemical space definitely went through pretty tough phase. There was overcapacity. There was increase in supply from overcapacity plus China, plus there was, destocking, which, hopefully will end soon. But this is the time when you need to do your work, and then at least be ready with two or three ideas there. There are they're not cheap, but relatively, at least, it's an attractive pocket. And especially if you can pick the right companies in that space, where, again, as I said, that the possibility of supply building up over the next 4 or 5 years is very, very little, other than the same companies putting up capex. So the growth opportunity will be basically benefited by the companies in which you invest. So if you find such opportunities, that's a space to go for. I think even the building material, like, if you see, say, the MDF plywood space, it is going through a tough margin phase, and there will be times when that will bottom. And it's a long-term structural story. There are spaces in, say, textile industry. So some things which are completely out of favor. I think even banking seems pretty reasonably attractive, which maybe is a pretty common consensus now. But still, I think, relatively speaking, to its own history, it has reasonably attractive valuations. And a lot of manufacturing, bottoms up specific manufacturing companies, where there is long-term structural growth. They're pretty fairly valued. So there are, they are not part of those excessively valued pocket, because anything to do with government, the PSUs, the railways, and the defense, and port infrastructure building, that has become pretty expensive. And again, I'm not sure about the supply there. Sometimes suddenly things can increase in supply, and you don't know, what Adani would do, and there could be supply in different industries, especially anything to do with the government. So one needs to be careful. You need to be sure that it's a tactical play. It's something that you should be, ready to exit at the right time. It's not something maybe that you can be confident that you'll hold for the next 10 years. And so I think those pockets, you stay away, and there are a lot of other pockets which are fairly valued, some which are maybe turning around, and maybe you'll find good value there. And that's where one needs to focus on.
Right, sir. So, sir, we are almost time. So, if you allow one, two quick question, I'll ask. Otherwise, we can
Sure.
talk about that.
Sure.
So, quickly on the how had been your investing and placement during the Black Swan event? Specifically, if we talk about the COVID, where there was no certainty what's happening around. So, how had been that experience with you?
Right. See, black swan events are something which cannot be predicted, so it's very difficult to do real analysis of building any positions or cash positions before that happening, because then it won't be called a black swan event. But COVID, see, we were, maybe some part of it was just luck, that we were little high on the cash side already at like 10-12%. And then in the first week of March we took a call that there are too many unknowns. Sometimes if there are known knowns, that the risks, how it's going to play out, the extent of risks, sometimes it's too late for you to take any action. But in the first week, the situation was just emerging, so we took a call to quickly raise. I mean, you didn't even get any chance. I mean, the market started falling like 5-10% every day, but we still could raise. We planned to raise 25%, but we could raise only about 17-18% cash. So that was, I would say, pure luck, something which I don't know whether it's part of a process, but you can at least use that framework of going forward. If there are too many unknown risks, from a macro perspective, from a business perspective, at that time maybe it makes sense to be really conservative and prudent, and it's okay to have little higher cash in the portfolio, and especially if you're in the small and mid cap space, because the fall in there, I don't know whether it makes sense to have that in the large cap space, but in the small and mid cap I've seen, the from the top to the trough, even in the 2018 to 20 cycle, small cap had fallen by 65%. That's a very sharp fall. You need to go up 3x. So even that, 15-17% cash, actually, if you look at the pre-fall ratio, it is actually 3x of that, right? So that's the kind of benefit you get. But otherwise, my cash levels are completely based on the valuations, the opportunities that I'm able to find. If I'm able to find opportunity, I'll be fully invested. But sometimes I'm not just going to invest because I have cash if I'm uncomfortable with the valuation. So if I exit a company or two, and if I'm not able to find good options or alternatives, I'll sit on cash until I find a good alternative.
All right, sir. Although you already touched upon these few criterias of selling, but broadly, like when you sell, sir.
See, selling first, most common selling for me is if I start seeing that this company cannot double its earnings in the next 3 to 4 years. That's an automatic sell. Then it doesn't matter what the valuation is. If that growth rate falls below 18%, I would sell. So that's first. Secondly, valuation. Valuation, I'm pretty flexible with. I'm okay with slightly higher valuation, or above fair valuation, if I'm holding that position for a long term. I know that long term this is a really good business, then I'm very flexible on the valuation. Of course, it becomes super expensive, I'll exit. But in terms of fair valuation band, I think it's pretty wide for such companies. Or if there is I mean, as I said, most businesses are cyclical. There are cycles which can turn around, for specific, like for example, what happened, say, in chemicals, or what happened in the textile. At that point, that you are entering into a very slow phase, for the next couple of years. Then you exit that point, but still keep on studying those businesses, or something that management does. They announce certain capex or some corporate action which you don't like. That also becomes an event for exiting.
All right, sir. And another important question is, sir, like how important do you think skin in the game is for a fund manager?
I think, see, question is, how is the fund manager spending his time, right? So if the the fund manager has skin in the game, which can be pretty large sum, but his maybe half of his capital is in completely different set of stocks. That means then he will have to spend a lot of time on evaluating those, which is against the interest of an investor. So I think it's important that the fund manager spends all his time, at least in terms of investment, only on the client portfolio stocks and not for his own set of stocks. So that's more important. If he has all his wealth in the same set of stocks that are with the client, then you end up basically spending most of your time on those stocks. So that is more important. And yeah.
Right, sir. Thank you. So one last question from Vimal. Vimal, quickly unmute and ask. We are short of time. Sorry. Yeah, please.
Good evening, both of you, sir. Samit sir and Sajal sir. Hope you're doing well, both well. Only, hello, sir. I'm audible.
Yes,
Yeah,
yes.
go ahead. Go ahead.
Please.
Okay. Thank you, sir. Sir, any technical parameter are you consider in buy or sell?
I never used to consider technical parameter buy or sell, but still we do have someone who is good at maybe longer term trends, especially for exits. For exits, I think, if you get a signal in terms of, exit, and then at the same time, if you are confused on the fundamental side, it gives you a little more sort of inputs into that exit. While entry, there is nothing technical that we really look at, but exit sometimes is so important. And when the valuations are high and you are in sort of a double mind, whether to exit, whether to hold on, then we do take some guidance from the technical aspects, not the daily technical, but a longer term trend, if the trend has changed or not. And it doesn't have to happen at the stock level, it can happen even at the industry level. So I would say beyond that, nothing.
Great. Thanks. So, Sajal sir, anything to say before we close?
No, nothing to add. Let Samit go. It's been a long day for him. Beautiful learning. Fantastic interaction, Samit. Thank you so much.
Absolutely, my
Thank you
pleasure.
so much for taking
Thank
out
you.
time and helping us with your great knowledge and humility, sir. Always a pleasure listening to you. And there were so many requests, but again, in the want of time, perhaps some time down the line, we can surely accommodate.
No, absolutely. Actually, today I would have extended this,
Yes,
but
yes, sir. I know.
there's
Sir.
some. I have to go to the
Oh,
hospital now for some friend.
okay, sir.
So that's the only reason. Otherwise, I would have extended
Not a problem, sir.
very brief.
Yes, sir. Please take care. Yeah. Thank
Yeah.
you, sir.
But thank you so much for everyone's
Thank you,
time.
sir. Good
Yes.
night. Take care.
Good night. Good night. Bye.
And for those who joined late, we have recorded the session. Surely you can listen to the conversation when I upload the session on my YouTube channel. And if you are yet to subscribe, please you can feel free to subscribe so that you can listen to amazing conversation with the financial market experts. Thank you so much. And sorry for those whose question I couldn't take in the want of time. Maybe next time we'll try to accommodate everyone. Thank you so much.